By the end of this video, you'll be able to look at any income statement and quickly assess a company's financial health, even without a background in accounting. We're breaking down financial statements into practical insights every business leader can use. You'll learn how to use 3 essential ratios: days sales outstanding, current ratio, and gross margin, metrics that top analysts rely on to spot strengths and risks. Most executives make decisions without the full financial picture. In fact, 82% of business failures are linked to poor cash flow management, not lack of sales. That gap in understanding can create serious blind spots when evaluating performance. Let's look at why strong sales numbers don't always tell the whole story. If you're new here, please subscribe and like, because I share tips to help you improve your career. Strong sales can mask underlying financial risks that threaten a company's survival. Many executives focus on revenue growth and overlook the working capital metrics that determine whether their business can actually meet its obligations. According to US Bank, 82% of business failures result from poor cash flow management. This means that even companies posting impressive sales numbers can find themselves unable to pay suppliers, cover payroll, or invest in growth. Let's look at how this plays out in practice. Imagine a retail business that reports $5 million in quarterly sales, yet struggles to pay its vendors on time. The income statement highlights robust revenue, but the bank account tells a different story. This disconnect often stems from decisions made to drive sales, offering generous payment terms to customers, for example, or investing heavily in inventory before it sells. Meanwhile, fixed costs like rent and salaries continue to drain cash, regardless of how much product is moving out the door. When cash from sales lags behind expenses, even a growing company can face a liquidity crisis. The root of this issue often lies in the difference between accrual and cash accounting. Accrual accounting records revenue when it's earned, not when cash is received, while cash accounting tracks actual money movement. For example, consider the case of Rough Times, a subscription-based pet supply company. When Rough Times ran a promotion, it booked thousands of new subscriptions as revenue under accrual accounting, even though the cash would be collected over the coming months. This created a rosy picture on the income statement, but the company still had to pay suppliers and cover shipping costs before the cash arrived. Without careful attention to cash flow, these timing mismatches can spiral into major problems. Working capital metrics, like days sales outstanding, days payable outstanding, and inventory turnover, help bridge this gap. They reveal how quickly cash moves through your business and whether growth is sustainable or precarious. Many leaders underestimate these indicators, leaving their organizations vulnerable to cash crunches. Understanding the relationship between sales, accounting methods, and cash flow is the first step. To make better financial decisions, you need to see how financial statements interact and what they reveal about your company's true position. If you're finding this helpful, please subscribe and like, because it helps us create content that matters to you. Also, if you want to take your skills further, check out our executive education and executive coaching programs at execbeat.com. Decoding financial statements is essential for making informed business decisions. Each statement offers a distinct perspective. The income statement shows how much profit a company generates. The balance sheet details what the company owns and owes at a single point in time, and the cash flow statement tracks the actual movement of money in and out of the business. When you read them together, you gain a comprehensive view of both performance and stability. Real-world challenges often emerge when leaders focus on one statement in isolation. For example, Rough Times, a subscription-based pet supply company, saw impressive revenue growth on its income statement after a successful promotion. However, the cash flow statement revealed that much of this revenue wouldn't convert to cash for several months, creating a shortfall when it came time to pay suppliers. By reviewing all 3 statements together, the company recognized the need to adjust its payment terms and inventory purchases, which stabilized cash flow and prevented a potential crisis. Understanding how these statements connect is grounded in the accounting equation: assets equals liabilities plus equity. If Rough Times used cash to buy inventory, its assets would shift from cash to inventory, but total assets remain unchanged. If it borrowed money to purchase inventory, both assets and liabilities would increase by the same amount. This relationship helps you spot where operational decisions impact financial health. To simplify your analysis, start with a few high-impact ratios. The current ratio, calculated from the balance sheet, shows whether your company can cover its short-term obligations. A ratio below 1 signals liquidity risk. Gross margin, from the income statement, reveals how efficiently your business turns sales into profit after covering direct costs. Days Sales Outstanding, DSO, which bridges the income statement and balance sheet, measures how quickly you collect cash from customers. We'll explore more ratios in detail later, but mastering these three gives you a strong foundation. With this analytical approach, you can move beyond surface-level numbers and uncover actionable insights that drive better business outcomes. Developing financial literacy gives you greater control over your company's direction. When you review statements regularly, you can spot trends and address issues before they escalate. For example, Rough Times recognized the importance of recording deferred revenue under accrual accounting during their subscription promotion. This allowed them to match income with the period it was earned, even though cash would arrive over several months, helping avoid surprises when managing supplier payments. Make it a habit to examine your financials monthly, track profit trends, monitor cash flow timing, and review key ratios. Set aside 30 minutes each week to review one financial statement component with your team. Numbers reveal operational truths before problems become visible. Mastering these documents is a core leadership skill. Your ability to interpret them directly shapes your business's future. For more detailed walkthroughs of key ratios, check out the playlist linked below. Thanks for watching. Please subscribe and like, because it helps us bring you more free videos. And if you're ready to grow your career, visit execbeat.com to learn about our executive education and coaching.